do like to start off the show with a summary of what we saw happening in the stock market. So we're going to do something a little different today. We're going to start off with the summary, go through what we saw happening this week, and then Ethan and I are going to do like a little brainstorm, pro and con. What are the things that can maybe make the market continue to go up?
Mhm.
What are the things that can stop that momentum and make the market go down? Right. So I think that's interesting because that's kind of how I always look at investing. It's this teeter totter mentality or tug of war, who's going to win that tug of war, and you're basically trying to handicap that contest. And so, obviously, this is the chart we've been looking at. It goes back to the late 2018. That initial drop at the very beginning of the chart was the last time we had tariffs. At that time, much smaller than what we have now. Had a nice recovery. Of course, we had the pandemic. We had the big run up after the pandemic, and then inflation hit in 22, and it fell. So here we are now, moving along, hitting new all-time highs. The market is moving very smoothly, actually, and continues to go. And we'll talk about some of the reasons why, as far as that goes. But some of the things that were reported this week, which were important, first of all, is a producer price index. So this is wholesale prices. And so if you look at kind of inflation itself, it would start with the increasing commodity
Mm.
prices. And then you would have the ISM survey of manufacturers. And in that survey, they ask, are your costs going up? Yes or no? And then you would have that come through to the producer's price index here, wholesale. And then theoretically, it comes through to CPI, inflation, or PCE is another inflation measure that the Fed looks at, right? So that's the lineage. So actually, the producer price index went down for the month. It was month over month. It was down zero point 0.1. Now it was up a lot the month before, up
Yeah, it
zero
was
point 0.9.
kinda unexpected that
Yeah.
it went down so much.
So between the two, now we're at like zero point 0.4 over the 2 months percent. But you can see on year-over-year basis here, it's a little bit over 2.8%. Again, way off of where we were back in the higher inflationary period, and more or less in range at this point in time. So we're not seeing a huge impact, from tariffs or deportations, at least in this particular report. And then the next report that came out was a consumer price index. Again, this is the core index. That is on a little bit of a rise. If you look, still quite low compared to where it was back in the, 22, 23 time frame, but it's at 3.1%. They always talk about that 2% target that the Fed has. It is on core inflation, and this is core CPI inflation, but they don't mean it on core CPI. They mean it on core PCE. So
Yeah,
it's
with
important.
PC, there's a little bit lower of a percentage because you're able to do substitutions while
Yeah.
CPI has a very fixed basket.
Yeah, I think ironically, we'll see what happens here at the end of the month, but I believe at the end of last month, the core CPI, PCE was about the same, year over year, about 3.1%. So nonetheless, kind of going away, we got down into that 2.4, 2.5%, and we're kind of crawling back up. So there is some impact, but it could just be noise, honestly, and it probably is so far. So I think we have some trends that could be developing, worth watching, but it's hard to tell. One of the biggest things that happened was this revision in the monthly jobs number. So this is a chart that actually goes back to 2015, and based on a percentage of the number of jobs that were reported, okay, over the 12-month period. And so what they do is in September they release this for, in this particular case, for the 12 months that ended the end of March 2025, right? So it's 6 months later, they've been able to get more information and tighten up the numbers, and they dropped 911,000 jobs.
It's a
Okay.
big number.
It's a big number, and as a percentage, it's actually a little over 90% of the jobs that were reported weren't actually there in the end. Last time, you can see the other red bar right next to that is last year. It was 800,000 jobs. And so, you can see, and actually in 2019, that was a 98% reduction in the jobs, and some of those big up ones. So it's not a clean report by any stretch of the imagination. Every time they make this adjustment, sometimes it's quite large. However, it did create a situation, and I think this is important with CPI being, yeah, within expectations,
Mhm,
with the, job numbers being revised down, the other actual current job reports being fairly weak, it really stimulated the market in the concept of having this rate cut, right? And so that's all week I've been reporting essentially bad news about the labor market, and the stock market has continued to go up on all of those reports,
mhm.
right? This is where that bad news is good news, right? As far as that goes. So, we'll talk about what that means and kind of where bad news can become bad news.
Yep.
Yeah, right. Um, and so this is the other thing that came out. This is initial claims for unemployment. So this is done every week. How many people have had their first time claim for unemployment this week?
Mhm.
And so it went to 263,000, which is actually the highest we've seen since the 2020 big downturn, right? Lots of unemployment claims because people are closing businesses. And so, again, that made the market happy because, again, softer labor market means that you've got a situation where the Fed is more likely to cut rates more times.
Yeah, and the dramatic spike was a lot of people were attributing it to the Texas floods, where
Mhm.
a lot of people were starting to claim benefits from that.
Yeah, that makes sense. Yeah, there's a bunch of businesses, I'm sure, that were wiped out there and what have you too. So, yeah, and so, we'll see how that plays out. To me, so far, what we're seeing is I will say if you look closely at this chart, it was kind of bottoming out at January 24. We've got a lot of purple after that. So you got a fair amount of job weakness that's happening. And not just this year, but even starting last year. And I think that's one of the things that we're seeing is in general that the trend for this didn't start with, this current administration even. It started, at the end of last year or at the beginning of last year for that matter. So here's something that I think is important. So the market gets really excited about rate cuts.
Mhm.
And that's because 80% of the time, 12 months after a rate cut, the market is up. And so the study that we just looked at said 4.9% to 14.1% is kind of the range after a rate cut for how much the market is up. So think about that. If you're a betting person and you got an 8 out of 10 chance, you're going to bet on that, on a regular basis. And that's why money comes in when rates go down.
Mhm.
Period. It always does. Now, it doesn't always work. The other 2 out of 10 times can be fairly dramatic. And so, for example, here's some cycles where it was negative 12 months later. So 1973, it was down 36%. That was the oil crisis and recession, right? 1981, 12 months later, it's down 17.8. We had high inflation, you know, something we could get here, and recession. 2001, dot-com crash and a recession, that's down 14.9. 2007, financial crisis, recession, down 27.2. So what's important about all of those is recession.
Yeah,
The word recession, it's in every one of them.
yeah. Rate cuts don't save the economy if they're in recession.
Yeah, exactly. So that's where the Federal Reserve, something happened that was dramatic and not known, like we actually saw in the financial crisis, or you could take rate cuts to zero, like they did at the end of the 2000 downturn, the end of the 2008 downturn. Still not enough. It's still the economy is still spiraling down, and so oftentimes, actually, what they did in 2008, rates are already at zero, so they started pumping money out
Mm.
in all of these little bailout forms, sending out actual checks to people. And, it worked. It actually got us out. Same thing we did in 2020. Rates went to zero after the pandemic, but they pumped out a ton of money. And in hindsight, probably too much. Things went nuts after that. So it is important to realize that rate cuts are good unless you're heading for a recession. And so that's kind of the concern about, what what might be coming at us because some of the negatives, which we'll talk about here in a minute, and the pros and cons, have that capability of creating a recession, even a really large one.
Mm.
So we'll talk about what that means. But that's where I think you have to take it with a grain of salt when they're cutting rates. Usually they're doing it because something's falling apart. 8 times out of 10, they're able to do it and things turn around, right? And there isn't a recession to really deal with. So hopefully we're in that 8 out of 10, but we have to be careful of, when these happen. And the last one was 2007. That was a while ago, and we've had a nice run up. We've got the first or second most expensive market, depending on the measure you're looking at in history, going back to the 1800s. So you're more likely to have pullbacks when things are stretched out this far. And so then here's something that I think is very interesting. The reports that are coming from the government right now are the reports that you would want to see if you were hoping for more rate cuts.
Hmm.
So, in other words, if you're going to do a jobs revision report, you'd like it to be higher, not lower. So, it was the highest we've seen in a number, 911,000 revision. Uh, and so we got higher. We would like to see lower inflation. We got lower inflation on the wholesale. We got lower inflation, at least expected inflation on CPI, right?
Hmm.
And so the problem is that these numbers are coming directly from the government. And the last person that was in charge of those numbers got fired. And so and this is just something, no matter what your political persuasion, the concern would be in that scenario is the new person, and running the Bureau of Labor Statistics, is that person going to put out bad numbers, right? Or the numbers that, in this particular case, actually employment growth would have been bad if you're hoping for rate cuts, which is what Trump's been talking about the most. So are the numbers going in line with making those rate cuts? And so it could be exactly accurate, but there's going to be a continuous suspicion because the last person got fired. And does the next person want to get fired? Probably not. Does that mean that they want to produce the numbers that will keep them employed? Maybe. That's a problem. So what do we look at, right? Well, first of all, this is the ADP report. So this comes out, really just before the big jobs report that comes from the
Yeah, it's usually the
Bureau,
day before.
yeah, the Bureau of Labor Statistics. Now, this is private payroll, doesn't include public companies or government jobs. But it is something that is not produced by the government. This is actually done by the ADP, which is a big payroll service, right? And so, you can look at this. This is going back to 2010. You can see the big drop that happened during the pandemic. Uh, but it's still going up, actually. So it's kind of interesting. On a private payroll standpoint, we're still seeing, continued growth. I would say it's flattening out there if we look closely at the end of that curve. So that's something we can watch and maybe feel more confident, at least as a check against what we're seeing from these government numbers.
Hmm.
All right. And here's another thing, which is just commodity prices. So this is the year-to-date commodity price index through iShares. GSG is the ticker symbol, and it's definitely on an uptrend, no doubt. However, really that uptrend so far has really been recovery. Okay, so this is a basket of different commodities. This is one of the first things you would see moving up if you expected inflation to come through or even the tariffs to have an impact, is in this particular category. We have 50% tariffs on aluminum, copper, steel, etc. And we're seeing an increase. The trend is definitely up. However, if you look closely at that, we're really just back to where we were before the Liberation Day in April. So we've just recovered. So I think it's more important what's going to happen with this going forwards.
Hmm.
Okay. But again, this is not something that the government can control. This is actually a representation of what's happening in that market, right? With those particular commodities. So that's something to watch if you're a little bit worried about what's being produced. And then maybe the last thing here is just earnings. So the orange line is the earnings for the S&P 500 per share, and the blue line is the actual S&P 500. You can see the correlation there. Um, but the earnings you can see it's flat right where it is right now. That's mainly because we haven't had a lot of earnings reports.
Hmm.
And so it does flatten out once in a while while we're waiting. But overall, the earnings are still up. Right. So, but we want to watch those earnings. Do they start to have problems? We want to watch that commodity thing to see for inflation. We can watch the private payrolls to see if there's deterioration there. All of those things are not controlled by the government. And these are all, earnings are reported by companies directly under pretty strict regulations, et cetera. So these are the things that, we would be watching as far as that goes. And so anyway, that's kind of the summary portion, and let's just talk about a little bit of pros and cons. So what are some of the things that we can think of why the market would go up? Okay,
So
you could
consumer
start.
spending is still resilient. Consumers are still going out and purchasing things. Labor productivity is up too in the
Yep,
last quarter.
yep,
So,
yep.
even though, labor market's doing less, you're still producing the same amount.
Yeah, and that's maybe one of the biggest drivers is artificial intelligence and the spending on artificial intelligence, and perhaps productivity has picked up there because of,
Hmm.
hey, we can do this with 3 people instead of 4 because we're employing, an artificial intelligence in that particular group, and they're getting more done, right?
Yeah, and then having that anticipated rate cuts and multiple rate cuts at that
Yeah,
really
yeah.
drives the stock market well.
Yeah, and I would say that we can throw in the big beautiful bill as one of the stimulants to the stock market for a couple of reasons. Number one, it gave some clarity on what taxes were going to be because
Hmm.
otherwise there would be none. It was supposed to sunset the all of the tax rates and what have you, especially on the consumer side, and that's now extended out. There's some potential cuts in there for different types of people with different credits that they included, which is, again, stimulative. But the one thing that I think is the most interesting is the bill is supposed to produce about $3.3 trillion of deficit, according to the Congressional Budget Office, over a 10-year period. But if you look at it, actually the deficit is higher on average at the very beginning of the bill because they're spending the money, in this case, like Homeland Security and building detention centers or whatever they might be doing, but they're not saving the money like with the Medicare cuts and some of those other types of things. They delayed those until after the midterm. So that means cash flow, positive cash flow is coming out of the government. Government spending is a stimulative to the economy,
Hmm.
right? It just is. So uh, I think the whole thing revolves around the AI trade. If AI turns out to be something that isn't what everybody's hoping it is, market would probably fall like tomorrow, just because that is the main driver of the whole thing as far as that goes. Uh, what are some of the other reasons the market could go up? Um, I think that's the majority of them. I would say regulations and maybe continued deregulation. So we've seen some deregulation of some of the banking pieces. Most of what's happened to banking means that they don't have to have as much capital on hand, which just
Hmm.
means that capital can get out and start moving and maybe stimulate the economy.
You could say trade deals, even though trade deals like are kind of negative in their the cost to them, they provide certainty, and then that certainty allows business to invest, and then being able to have that certainty allows them to grow.
Yeah, the market seems to have really calmed down about the whole, tariff situation, and maybe even more so now that there are a majority of them seem to be more or less settled. I know China was just kicked down the road another, whatever, it's 30 to 90 days. I think it was 90 days to November 10th. And
Yeah.
so, you know, that's okay. At least there's something there. Lots of threats being thrown around like, hey, you should, Europe should do 100% tariffs on India and Russia because they're still using Russian oil.
Yeah.
Not India, Russia, India and
In
China.
China.
Yeah, because they're still using Russian oil. So, okay, so that I think that's the majority. I think the deregulation, yeah, that's a good piece. All right, so then the other side, of course, will be, uh, you know, the tariffs are at the top of that list. Tariffs historically at these levels have been pretty disastrous,
Hmm.
and sort of as a pro, they also don't stay there historically at these levels. They come back down, which you could say is a good thing. If that does happen, if it's just temporary at this level and it comes back down pretty dramatically, market could sail right over that.
Yeah. The
But
the one problem with that is the legality of the tariffs now cause a lot of people just to wait.
yep, yep,
Can I wait 3 months and know have for certain there's going to be tariffs or no
right.
tariffs? I'm not going to do anything for those 3 months then.
That's right. I would think it completely weakens the negotiating point that we have or power that we have because a lot of these have already been determined. But whatever's out there that might be moving forward in terms of doing negotiations, if I'm on the other side of Trump here, I'm slow walking things because maybe they go away and I even get a refund of the tariff that I've paid in the past. So I think it's quite possible that the Supreme Court does side with the 2 lower court decisions because it's really hard not to, but it's not impossible in this environment to see the Supreme Court decide that these tariffs are okay or give that power to the president forever, um, which is kinda interesting. So it's a big precedent-setting case. However, they also have other ways to get tariffs.
Mhm.
So I think tariffs are still a problem at the level that they're at. If they start doing line item tariffs instead of these emergency tariffs, the tariff is semiconductors and pharmaceuticals and all these other types of things, um, those could be pretty high. And it's hard. There's not a country that's going to complain about it per se, like there is in this direct country to country. If it's just pharmaceuticals, then it's these pharmaceutical companies,
Mm.
which I don't know, they have good lobbyists, so who knows? But nonetheless, and so I think the other obviously thing is deportations. So I saw something. We're going to have the slowest growth in population in 2025 that we've had in a really, really long time. And growth in population has a direct correlation to growth in the gross domestic product.
Mhm.
So when you shrink or slowly grow the growth because of deportations, that's a piece. And then obviously the biggest impact of that is the potential for lack of labor in certain industries, whether it's construction or the, restaurant hotel industry or, agriculture or the meat processing plants or whatever it might be, or trying to build a battery plant in Georgia. If we ship all these people out that can do these jobs, either because their expertise is something we don't have currently and we need to learn, or because they're doing a job that nobody really wants to do
Mm.
here. I don't see a bunch of Americans running out to get jobs in the fields. It's a really brutal job. And so anyway, and I would suppose that in order to get those people out, they're actually going to have to pay more. So that has inflationary potential, and we are seeing some of that already. We
Yeah, you
saw,
can see the reacceleration of the inflation now.
yeah,
But that
in the food. So they are trying to do some things to try to, like I saw an article talking about coffee has gone up 21%, and they're talking about making an exemption for coffee because we really can't grow coffee here
Mhm.
at any great level at all. And so, and that's going to hit that consumer right in the face and that voter right in the face every time they're going to get their coffee. And generally, I would bet that people know what their coffee costs, and if
Yeah.
it jumps up a bunch, they're gonna know, and they're gonna know who to blame here. There's actually some other reasons why coffee might go up, but I guarantee you they'll be talking about tariffs,
Mhm.
not lack of rain or whatever it might be that also contributes. And then, of course, we've got the independence of the Fed is being really attacked here altogether. And if it's successful and the Federal Reserve becomes political, that is not a good thing for the stock market.
Mhm.
No, the Fed needs to be able to be independent and make those decisions based on sound economic policies. They're not good at it. Nobody's good at it. No, they're not. They're late. They're early. They're not right on time. However, if you just get in there and say, "Hey, we're going to reduce them 2 or 3%," right away, I'll bet you that you get the exact opposite of what they want out of that. I bet you the other bond, because the Fed only reduces the shortest terms
Mhm.
of the market, and the market has to respond to that. I think with the Fed being politicized, the market's going to want to be paid more, the bond market, for longer term
Yeah.
treasuries, which is where mortgages sit.
Yeah, people look for or investors look for stability. Having a politicized Fed is not stable because you're gonna make you're gonna try and overheat the or you're trying to grow the economy always, and so you could probably overheat. You could be throwing too much fuel into the fire.
Yeah, exactly. So that's kind of it's the tug of war, does the AI and the productivity and the lower interest rates and the, tax situation being solidified, lower regulations, does that outdo, the tariffs, the deportations, the independence of the Fed? Those are the big ones, certainly, in my
Yeah.
opinion. And so when we look at like what happened in 2000, I said this last week, but I think it's important. 95 to 2000, we had a lot of those same positives, especially the dot com, which was exciting, biggest driver in my opinion. And that's the biggest driver now, which is the AI, which is exciting, right? And there's money pouring into that. Uh, However, in that time frame from 95 to 2000, we did not have a, uh, you know, tariffs. We didn't have mass deportations that are scaring people from going to work. We didn't have this independence of the Fed being challenged. So those are things that are headwinds that are going to make it so that we can't really complete that big 5-year run that we probably would have had.
Yeah, another thing to think about is also I think that was one of the few periods that also the U.S. government was running a surplus.
Yes, that's right. There was a period in there. It's the only period that I can remember in my lifetime, actually, where we were running a surplus. And so, it was working really well. And I guess that's something we didn't talk about and we should be talking about is the actual debt load because the big beautiful bill is a positive on one side, but it's also a negative on the other
Mhm,
because it's going to, in its own structure, it's going to create a higher deficit, right? And the bond market's already at 37 trillion, and the interest is growing because rates are higher.
mhm.
And Ray Dalio, who's one of the big hedge fund managers, who's running around talking about a debt heart attack, right? And basically, what he's saying is that the load of the debt will continue to get bigger, and the interest rate will start to eat up more and more of the overall budget.
Basically.
Yeah, and that means they got to borrow more, right? So that's the spiraling, level. I would say that probably takes more time than some of these other things, but it's hard to say. I mean, if you really start messing with the Fed and rates go crazy on one end, you could create more problems pretty quickly there. We'll see how that goes, but that's another one that's on the other side. So anyway, that's hopefully that helps a little bit to understand. Again, we're two-thirds in, one-third out of our normal allocation in stocks based on this pro and con kind of teeter-totter, tug of war situation. There's enough things tugging on the negative side to say, okay, we don't want to be 100% in.
Mm.
If you took, those three big things out, with the tariffs, deportations, and the Fed piece, we'd be 100% in. So it's just a matter of seeing how those play out. I will say that one thing to keep in mind is those big negative things, they could go away really quickly if I don't know that they would, but in theory, tariffs could be lowered by Trump like tomorrow, next month, whenever there's problems. So he could bring that down. He could carve out all kinds of line item things on places where we're having trouble. So, and they've done that actually to a large degree. It's a matter of being able to do that before something breaks, but that's possible. It's also possible that they change the deportation picture, just at least in the sense of being able to, because Howard Lutnick said, "Hey, the South Koreans should have come to me for the visas." Well, we shouldn't have to go to Howard Lutnick to get the visas. There should be to keep that plant. They're building that plant. They had 300 South Koreans there. And it strikes me that we just need a program that is efficient, that works. And my gut feel is that they're slow walking any visa stuff because they don't want anybody in the
Mhm.
country, even if we need them in the country, like we did for this. And so that probably just backfired as far as that goes. But that could change, right? That could be something that gets improved dramatically, helping the farmers, right? Bringing in people, helping the meatpacking plants. So they could do that. Now there's a push to do the opposite, which is just to remove everybody who basically isn't white for the most part. Uh, However, it could change. And then, of course, the Fed piece, it could change also. They could back off on the criticism and whatnot. So that makes that handicapping even harder. You could make an argument that maybe all of these negative things just disappear and don't cause any real problems. And that's basically the argument the market's making right now, hitting all new all-time high. So you know, I will say that these things do take time to have impact. I've read several articles. Oh, the tariffs have no impact. Well, wait a minute. Let's wait a while to see, because the studies are showing that 15% of the tariff is being paid by the
Export
exporting company or country or mixture thereof. 15% is being paid by the
consumer.
consumer, and 70% is being paid by the company, the importer. So that's why we're not seeing big impact on price. But the expectation is that's going to reverse. It's going to be 15% that the company absorbs and 70% that the consumer absorbs. I'm rounding from what this study said, but it's you get the idea. So anyway, that's what's happening this week. Again, lots to talk about, lots of things that are very, very interesting that are happening right now and how that has an impact. But I look forward to being able to cover that again, here in the future. So